From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, September 20th, and you're listening to the HPS Macrocast. I'm Michael Steel, a partner here at Hamilton Place Strategies, sitting in for Tony Fratto, and I'm joined by John Fagan and Brendan Walsh from Markets Policy Partners. So Tony is traveling today, so I'm sitting in for him, which means that the average familiarity with the markets and overall intelligence of this conversation is going to take a real nosedive, but hopefully the perspective of someone who went to journalism school twice because he couldn't do math will be helpful in maybe dumbing down this conversation and making it a little more illuminating. So let's start with kind of the big news in markets the past couple of weeks. The Fed has cut rates for the second time this year. Guys, does this mean we are headed into a recession?
Well, we hope not. And so on Wednesday, the Fed had their meeting, and kind of since the meeting, the market reaction has been relatively muted. And from the Fed perspective, that's exactly what they want. Right. They basically delivered what the market was expecting. So they cut the rate from 2% to 2.5%. They have a 25 basis point band that they kind of try to keep it in. So now they cut it by 25 basis points, a quarter of a point. So now we're at 1.75 to 2%. Also, within the statement, they justify the need for the lowering of the rate by citing the implications of global developments for the economic outlook, as well as muted inflation pressures. So definitely still calling out towards the Chinese trade war.
Right.
And but this one actually, below the surface, it was a little more confrontational or difficult. I wouldn't say confrontational, but we had three Fed presidents. Right. Who disagreed. Two, that President George of Kansas City and also President Rosengren of Boston, they did not want to cut. And actually Rosengren came out today with a paper and basically cited we're kind of making money so cheap right now that you're seeing kind of a lot of leverage being put in the system and potentially bad loans, both on the consumer side, but especially on the corporate side.
And how common is that kind of dissent, that kind of disagreement?
3 is very rare. Yeah,
that's exceptionally high.
Exceptionally high.
2 is even pretty high.
2 is pretty high. You could always get the former Minnesota Coach Lacarda, he would always kind of dissent, but since he did it all the time, the market kind of ignored that. To have 3, especially after 2 were against, but then President Bullard also dissented, but he wanted 50 basis points. He wanted more.
So we found the Goldilocks option. We've got
right.
Some people say it's too much, some people say it's too little, so we're probably just right. Is that kind of the consensus?
That seems to how the market take it. Right. But then also within this report, each president gives their projections on their economic outlook. And the economic outlook was relatively rosy. But they also, it's called the dot plot. So they all put their dots of where they think the optimal policy rate should be at this year, next year, and the year after it. And this one showed kind of a pretty wide range of views for things going forward. So at it, we had 5 members that thought that the FOMC should have held the previous range of 2 to 2.5, or 2.25. 5 approved of today's 25 basis points, but see rates remaining steady through the rest of the year, and 7 favored at least one more rate cut this year. So while the markets are kind of calm right now, and we're happy with what they did, the Fed is going to have I wouldn't necessarily say a difficult time, but their communication strategy is going to be key in terms of keeping
market expectations.
Market
in the
expectations.
Right place. Yeah.
Sure. With such a divided committee, and Chair Powell in his subsequent press conference provided very little insight into the outlook. It
seemed deliberately opaque.
Well, in some ways, it was a pretty good performance. Honestly, he hit the ball right down the fairway. As Brendan said, he did exactly what markets expected. There wasn't clarity on the future trajectory, and even if he'd tried to make it clear with the committee so split, it's a pretty opaque situation. Talking about data dependence and taking every meeting as it comes over the next few months. So the markets basically, just after wobbling initially, they reverted back to their base case, which is pricing in roughly one more 25 basis point rate cut by year end, and then continued cuts into next year up to 2 more 25 basis point cuts by sort of spring and then later next year.
Yeah.
Now that's not consistent with the Fed's long range, but certainly in the near term, the 50-50 odds of another cut in October, that's well within kind of what Jay Powell was talking about in terms of taking these risks as they come.
So I was thinking about this, getting ready for this conversation last night, and I had one of those kind of wake up in the middle of the night moments where I can't help but wonder we're in such a long, historically speaking, expansion.
Yep.
Slow initially, but very, very long. There's zero,
and steady. Basically, we've been
steady.
growing about 2%, and every quarter, unemployment comes down.
And there's very little that can be done at this point on the fiscal side if there is a downturn. There's not room for more tax cuts, really. There's probably not room for a massive new spending package unless you buy into the idea that money is now so cheap that we're being foolish not
Yeah,
doing
well,
that.
this is actually a question that we should ask you, because markets are actually relatively optimistic about the odds of maybe some fiscal spending, especially on the infrastructure side. And then there's been a couple of proposals, one to index capital gains to inflation, and then there's another talk of a middle class tax cut. So Wall Street's kind of excited.
Yeah, I mean, I think that all of this is predicated on the political reality that the bright light on the president's record is the economy, right? Whatever you think about his boorishness or his foreign policy or various other things, courts, et cetera, he gets high marks on the economy. The economy is continuing to grow, record unemployment. And if we start seeing a dip or evidence of a dip, and there's not much that the Fed can do at this point, we're talking about fairly fine corrections, he's not going to be able to get anything substantial through Congress next year, not in an election year, not with Democrats desperate to replace him in the White House. So he's starting to look at these things like indexing capital gains and not only wondering, is this something we can do to goose the economy, but is this something we can do through an executive order without congressional action? I think the possibility of a real substantial infrastructure package is kind of a 2021 thing. And I think that's something that, if you're a newly elected president, either reelected Trump or newly elected Democratic
I think that's an important point.
You're looking for a big...
Especially on the infrastructure side.
If you're looking for a big win on domestic policy, you want one thing that you can get through what will most likely be a Democratic House and most likely be a Republican Senate. That's something that you can do that would be big and good. And the problem with infrastructure, as always, is how do you pay for it? Everyone loves infrastructure. Everyone wants new roads and bridges and go to ribbon cuttings and tell their constituents how much they're helping reduce their commutes and all of that. But the gas tax hasn't been raised in quite some time. It's a declining source of revenue, and there's not a great alternative.
But we could do the 100-year bond.
Yeah, just stand up an infrastructure bank, have them issue bonds, have the Fed buy it, boom, free infrastructure.
Or could mint $1 trillion coin and just give it to the Treasury and pay down.
No, but
pay
that
down
sounds
debt.
funny. But John and I were at a meeting with a bunch of Wall Street participants, and that question came up. And it wasn't a funny question; it was a serious. Could we do this?
Yeah,
it really is, and certainly we're hearing more from the Europeans about the potential for a little bit of fiscal loosening from Germany. We got that today. Some indications from Germany. It was a little bit mixed.
Right. Talk about that. Talk about Angela Merkel and what she said overnight and kind of what that means.
Right. Yeah. It's the missing piece of the puzzle in Europe is so obviously fiscal, and the space is the headroom for Germany to do something is so blatantly clear, and the economic outcomes are much worse. Right now we're seeing Germany could well be in a recession right now.
Yep. Right.
And all of the only institution that has answered the urgent call for easing has been the European Central Bank, and that's taken their monetary policy.
Who's run by an Italian.
Yeah, into really extremes. They just cut to negative 0.5 percentage point last week.
Which we've ruled out, right? Our Fed has said no negative.
That's what Jay Powell was very explicit on, and round of applause from me on that one. I think it was there was no ambiguity. He said we've looked at that. It's not right for us. And when you look at the track record of negative interest rates in Europe and Japan, you can't really look at that and say, boy, I envy what that's achieved.
And the only
It's not a
reason
recipe
that's
for
come
growth,
up is
right?
because the president is jealous that And he borrows a lot of money in his former career. Right. So if he could borrow negative, you're like, that'd be awesome. The only reason you ever get to negative rates is something went terribly, terribly wrong. Right. It's not something that we would ever be talking about except for the president tweeting and criticizing it and putting it on the front page of the news.
Well, and I guess that's my question: is given this long expansion, given the relative lack of options on the fiscal side, and the fairly low rates historically speaking, when we hit the next bump, are we not in danger of it being worse, the next recession being worse, because we have so few tools left in the toolbox to deal with it? Right, and that's one of the arguments for why the Fed may want to pause here a little bit, keep a little bit of dry powder just in case we do get a downturn. Now, obviously, as Brendan mentioned, St. Louis Fed President Bullard is on the other side of that, saying let's be proactive and make sure we cushion, get in front of these risks before they materialize, before it's too late. Now, that's not necessarily where the rest of the committee, the big split in the committee they're all over the place. So, if over the next couple of meetings they decide that really they are going to wait here at 50 basis points cumulative cuts, 0.5%, and they are trying to communicate to the market that they really are done for now, that's going to be a big challenge. This Fed has right now a lot of credibility on the dovish side. If they signal that they're going to ease, the market gives them 120% credit. They price it in and then some. But whenever they've been trying to pull the reins back in recent months, the market hasn't given them full credrit for that. And so I think
that's where Jay Powell has had his missteps. So while give him high marks for this meeting, he basically delivered exactly what the market said and didn't misstate anything, so everything was fine. If he then they decide we're not going to do it in the fall, that communication is not going to be well received by the market, and we have to see whether A, he has the ability to communicate it, and B, whether they have the backbone to actually try to follow through, or is the market going to be down 5% and they say, oh, sorry, we'll give you what you want. Particularly with the president tweeting up a storm.
Yeah, sure, he's not going to be happy about that.
Yeah, and if the Fed is really data dependent, what data are they talking about? Chair Powell has downplayed the labor market strength and a lot of the other strong parts of the economy. Is it going to be very specific points?
And specifically in this, they talked about a low inflation as a reason. Next week we're going to get the PCE, the core PCE price index, and that's going to be at 1.8% year over year with 2% their target. So it's kind of hard to make the argument.
Yeah. All right. Well, I think this is time for us to take a quick break, and coming up, we'll have a crude conversation about oil.
Are you or do you know a college student graduating this coming year? HPS is hiring. If you're interested in politics and public affairs and want to work in an engaging and fast-paced environment, be sure to check out HPS's entry-level associate and analyst program. Go to hamiltonplacestrategies.com/careers or email careers@hamiltonps.com for more information.
And we're back. I just wanted to start this next segment by talking about a story it's kind of the dog that didn't bark in some ways. The attack on Saudi oil facilities and the relatively muted market reaction. I mean, I growing up in the 80s or 90s, the idea of maintaining the supply of Saudi oil in the world market was a key American national security priority. I mean, you had American warships escorting tankers in the Persian Gulf. You had missile strikes going back and forth with Iranians. And it just, the war in Kuwait in 91 and the massive spikes in prices you saw around Iraq's invasion of Kuwait. Anyway, I was just amazed that, I pulled up to the Exxon the next day and gas prices weren't, double or triple or some sort of huge reaction to this pretty substantial damage to critical Saudi oil infrastructure. Why was it so limited?
It is absolutely remarkable, and we'll get into the fundamentals. But first, the point you made about how this very muted reaction. I mean, sitting in Tehran, they must be looking at this and saying, "What do we have to do?"
Right. I mean, you've got to think the point of this was to cause economic pain to the West.
Right? Yeah, we were sort of joking earlier. We were like, in Tehran, they should wear a T-shirt that said, "I took out half of Saudi Arabia's oil capacity, and all I got was $65 a barrel." It's crazy to think that's. I mean, I'm not a geopolitical expert or anything, but if you're thinking about the balance of power against the U.S. and Iran, oil prices. I mean, if those are tame under these circumstances, that's taking their queen off the chessboard, I would imagine. But there are obviously people that know it better than I did. Certainly after the attacks over the weekend, everybody in financial markets was focused laser-like on the opening of crude trading futures on Sunday night. And it was, the little betting before, I bet it's going to go up 20%.
Right.
I bet prices are going to be up 15%. At the open, they were up 20%. It was a big, huge pop, and they settled down right away. And they basically continued to slide. Certainly that first day being up, it was about $7 a barrel. But still that was only above, for Brent crude, only above $70 a barrel for just a fleeting minute. And then it slowly descended. And obviously the Saudi officials came out subsequently. Well, President Trump obviously gave the signals like the locked and loaded signal, but tempered it with
which his administration later explained meant that we had American domestic production, and therefore locked and loaded is a clear metaphor for American domestic energy production. Did you guys not get that the first time?
Exactly.
I felt crystal clear.
Yeah.
There.
and putting
Shale guys ready to go,
and putting the strategic oil reserve open to
tapping the Spro.
Tap it. Yeah, that was part of it. The Saudis came out and gave what seemed like wildly optimistic timelines for recovery. But if you're trading oil markets, oil responded to that when they came out and said we're going to be back online 100% by the end of the month. Oil prices kept falling and settling. Now, there were some subsequent reports that maybe Saudi have been a little over-optimistic on some of these, and we've gotten some back and forth in oil prices, but still, we're barely $5 higher than we were last Friday before these attacks. And that is, I think, a testament to the downward forces that we've seen on oil prices and shale supply. The gushing supply from U.S. shale producers is certainly a persistent headwind. And then, the other factor has been concerns about demand, concerns about growth. And that's been the other downward pressure, and obviously geopolitics and OPEC are pushing it up, and we've caught oil in a pretty comfortable range here, despite the big pressures on either side of it.
Well, it certainly has pretty substantial impact for the politics of the region and the national security priorities there. It's a lot different than what we're used to.
Yeah, and ironically, the big story that kind of came out and where the stress showed up was not in the oil markets and not in the overall economy, but rather in the U.S. Kind of short-term funding markets, which is a little wonky place, and it's kind of where banks and corporations lend to each other, and this was the big story from the oil was actually this stress, because what happened was in mid-month corporations have to pay taxes, so there's less money going around.
Right.
You also had a situation where the Treasury had a lot of issuance, and also we're trying to figure out what we're going to do with Freddie and Fannie and the GSE. So they've been a much smaller player in lending short term. But then what happened was on Monday morning, the Saudis pulled a ton of money from our U.S. money market funds because they were going to pay to keep things stable in Saudi Arabia. So overnight, when we woke up on Monday morning, kind of the front end of the lending curve went bonkers. And what happened was...
What does bonkers look like?
These are the lowest rates. It's just, it's very low risk cash management kind of lending, and the rates went to spiked 8%, 10%.
Yeah,
it was
from
crazy.
Basically 0% or 1%. Okay. Yeah. So the Fed has a couple tools. One is they to keep the Fed funds rate where in that 25 basis point band that I was talking about, they pay interest on excess reserves that the banks hold. So banks have to have capital, in case they have losses. So the Fed will pay interest on it. So at this meeting on Wednesday, the Fed actually lowered the interest on excess reserves a little more than 25 basis points. They did 30. That helps kind of anchor that.
And it's supposed to do that by giving the banks less incentive to put money with the Fed.
With the Fed.
Okay. And
they'd rather them.
It's supposed to make it more attractive for them to lend in these funding markets. And at the same time, the New York Fed markets desk cranked it up and started offering liquidity through through what they call repo operations, basically cash for you do an exchange of a security for cash with the New York Fed.
It creates money. So you, as say J.P. Morgan, can lend the Fed, say $10 billion. They hand you $10 billion, but you still get credit as holding that $10 billion in reserves.
Yeah.
So it kind of creates $10 billion. So each day they've been doing $75 billion. And that just literally pumps money into the system that didn't technically exist the day before. So it's a little wonky, but the big main story is it's worked.
Right.
As of today, rates are back to where they should be.
And the other thing is these are obviously vital funding markets, the cash management markets.
Right.
Huge numbers, huge volumes every day. But at the same time, even though this was quite volatile, it really didn't spill over into broad risk sentiment.
Not at all.
It's still pretty esoteric. Mm-hmm. And it didn't,
And also didn't spill over into longer dated lending. It was just a very specific
narrow window.
Of course, if it had gone on unaddressed, then clearly it would have had much greater impact. But the markets were really looking for the Fed to come in with obviously these injections of cash are temporary. The IOER, it's probably just a tweak, and it may not resolve the whole problem if they have this going forward. And so there was a sense that they may have to do a standing liquidity injection facility, or even go back to asset purchases, which are permanent open market operations. So what looks to it's a little hard to distinguish from QE, quantitative easing, asset purchases. And when you think about it, it's quantitative easing used to be an extraordinary accommodation tool. And now we might need a maintenance dose.
It seems like we're getting into a very different space than we're used to.
Yeah. Well, as a communication guy, how would you go out and explain that to the broader populace? The difference between the normal expansion of the balance sheet and quantitative easing.
I would call it anything other than QE.
Yes.
We need to. I want you guys to invent the least interesting term possible for this, and use 5 or 6 words if you have to. But we're going to maybe an acronym.
Yeah,
is what we wind up with, but not even one with enough vowels. So I want a 4 or 5 consonant acronym
that couldn't become a word.
Exactly. So it stays obscure.
That's right. Liquidity whippets.
And while you guys work on that, I guess we're going to take another quick break. We'll be back shortly.
This year, HPS is celebrating its 10th anniversary. Since HPS was founded in 2009, nearly 200 talented employees have contributed to all that we are today. Be sure to check out HPS Insight on Twitter and use the hashtag HPS10 for more on the anniversary.
And we're back. We wanted to start off this last segment here talking about some interesting news out of Federal Express this week.
Yeah, it's not earnings season, but FedEx came out with their sort of out-of-phase first quarter earnings results, and by all measures, they really looked bad, and they missed earnings expectations, and they guided much lower through the rest of the year, which means they warned that profits were going to be lower than the analyst estimates that were currently outstanding. It was a very gloomy outlook.
That's not fuel prices, obviously, since based on the last conversation. Is this Amazon's new delivery fleet? Is this other competition? The president's reform of the Postal Service?
Yeah, well, the ongoing breakup with Amazon was something that management flagged, but they certainly also put the spotlight on slowing global growth and trade friction. That was, the funny part about the trade issue is it really hasn't shown up in it's obviously something that corporations mention during earnings season a lot, but it's not uniform. Some companies seem to be dealing with it better than others, and I think in this case there was some blowback from the analyst community that maybe management was trying to hide behind some of these issues, and it was their lack of execution. It wasn't necessarily a very kind response from the Wall Street analyst community, but it does speak to the fact that we in the last earnings season when we got second quarter earnings, we had we had CSX, the rail giant, say that business is terrible, and they had a very bad outlook for the rest of the year. And then we had J.B. Hunt, the trucking giant, come out and saying business is great, and things look fine.
Is that because there's so much uncertainty around the trade war and what the president will actually let go into effect, and how long this will go long, and what kind of resolution there could be either quickly or long term? There's just so much uncertainty that companies are placing different bets about the impact.
Yes, and I guess that I would totally agree with that, and certainly the different the different commodities and goods that are covered. Right. It's not uniform,
right?
And so it does have a disparate impact. And obviously, some companies have the ability, more nimble supply chains or whatever it is. It's very difficult. It was one of the reasons why broadly speaking, the trade war risk was so hard to price in through 2018 because unpicking these really dense supply lines and finding the impact through each of them is just really hard. So everybody had to kind of wait for corporate management to come out and tell us, and they haven't told us a really unified story yet. FedEx, however, has given us the negative side of things. So.
And as soon as they get on the same page, I imagine we'll get one more tweet to upend the whole apple cart one more time.
Right.
Well, let's make sure we get through what we're looking for in the next week.
Yeah, nothing too groundbreaking, but we do get a manufacturing PMIs both for the Eurozone and the U.S., that's where we focus on this exact issue. If it's going to show up in the data for the trade war, this is where it shows up.
The PMI, so purchasing manager I am acronym challenged,
yes.
And so purchasing managers indexes are PMIs, and we've seen the global aggregated manufacturing PMI is in contractionary territory. Right now.
Yes, global, yeah. And actually, the ones in the U.S. just started going. 50 is the denominator between expansion or contraction, and we're right around there now for the first time. So where we used to be up in the 60s.
So this could be kind of a flashing red light if that
it has
number
been,
comes in. Yeah. Even lower.
Right. And also, the global data in the last month or so has kind of rebounded. So the risk now, I suppose there's maybe too much optimism that things are really accelerating. So that will be a focus. We'll also get a little glimpse into the German economy with both surveys on the corporation side, but also the consumer. On Thursday, we get second quarter GDP revisions, so it's the final revision, which shouldn't be too market moving. It's kind of settled there around 2% the last couple of revisions, and that's what's expected this time also. But the big one is, I kind of mentioned earlier, it's the U.S. Personal Consumption Expenditures Price Index, and this is what the Fed focuses on for their dual mandate of full employment and also price stability. So the one that they focus on is the core, where they take out the food and energy, which can be a little more volatile.
Right.
So they target 2%, and right now we are at 1.6%. That's on a yearly basis. But kind of when you extrapolate from the other measurements, the market's expecting that to go up to 1.8%, which is getting back within spitting distance of their mandate, while they're still citing low inflation as a reason for
and so you think this could influence future Fed actions if they're starting to see.
Yeah. And then, more importantly, they said they're data dependent. So we'll see actually if they are data dependent.
Yeah, that's a really good point. In the past, we've seen data come out, like even non-farm payrolls come out really strong, and the market hasn't reacted because Jay Powell has told the market you shouldn't react to this because we're not reacting to it.
Right.
And so what? Yeah, certainly this will be a big focus next week.
All right. Well, it sounds like we've got plenty to look forward to and some interesting data right on the horizon. Tony will be back next Friday here on the Macrocast with our usual guests. And in the meantime, have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.